And I do want to take the opportunity to thank the Gale Borden Library for allowing us to hopefully bring some valuable information to our community with, financial wellness. Hopefully this is a topic that a lot of people, I find a lot of people kind of asking me about. So I think it is a pretty important topic. We all have questions, and credit is a finicky beast. So hopefully we can answer some of your questions here today. Otherwise, I know that Sadia at Gale Borden Library is very good about communicating with me after the fact if you do have any questions. But like she said, we'd be more than happy to answer those if you want to enter in any questions that you might have in the chat box or the Q&A box. I know she's very good at monitoring those for me. So thank you so much to Gale Borden Library and Sadia for assisting us with this. And thank you all for joining us tonight. Luckily, it's kind of a dreary night out there. So hopefully you have nothing better to do, although I know we're all very busy these days. So, and one of the last things I know most of us want to do is be on another Zoom call. So I do very much appreciate you joining me here tonight. So let's go ahead and get started. We're going to talk about credit today and kind of getting an understanding of what it is and how it really affects us, and maybe some tips on how we can improve that. Or maybe you don't have credit, we'll talk about that as well. So a couple of objectives here that will make sure that you have a good understanding of what credit actually is, how lenders and other creditors are actually looking at you, why they're looking at your credit reports, maybe managing that credit and maintaining or building that credit, as well as how that correlates with the debt that you might have or are thinking about maybe getting started. So whether this is a fresh start for you, or maybe you've already kind of hit some snags along the way in your financial life, maybe you need to clean house. Hopefully today's session will really help you get started on the right road. So first and foremost, one of the things that we do want to know is, that we understand what credit actually is. You want to understand that credit is actually a privilege, right? It's a very new concept, considering we've really only kind of had credit cards for, we've really only come to know credit cards within the last 50 years or so, even though they've been around for longer than that, obviously, and credit in and of itself has been around longer than that. Credit itself is really just the fact that you are borrowing money with the promise that you're going to pay that back. That's really all that this definition is you're borrowing money for the here and now, and you're agreeing to pay that back on whatever terms you are agreeing to. Whether that's a credit card, you're agreeing to that really high interest rate in a lot of cases, or whether that's, a loan, whether it's a car loan or a mortgage. You don't necessarily have the funds to purchase those things right now. Typically their credit is used for larger purchases. Although for us in this day and age, credit has really become much more convenient. And so we tend to use it for, to buy that $1 Coke at McDonald's. Hopefully you're paying that off, and we'll talk about the best way to use credit here. But there's 4 real main types of credit. Your charge cards that you see there on your screen, these are not very common anymore. These are very similar to credit cards. They look just like a credit card. The real difference between a credit card and a charge card is your charge card typically does not come with an actual credit limit. Charge cards are typically going to require you to pay them off every month. And many times they come with pretty large annual fees attached to them. So a real common charge card used to be a Diners Club card. American Express started off as just a charge card for many years. So again, these are typically not going to have an actual credit line that's available to you. They're kind of limitless, but they're very income driven, and you have to make sure that you can afford to pay off everything that you charge on them for the month, because you're required to pay that off every month. Your revolving credit, these are your regular credit cards. These are what most of us are using almost on a daily basis, right? This is the one that we kind of whip out, our Discover, our Visa, our MasterCard. We typically have a credit limit that's attached to that, whether it's $500, $1,000, $2,000, whatever that credit limit might be. You can't go above and beyond that. Typically, if you do go above that, there's going to be some sort of fee that you're going to pay for doing so. But a lot of times this is where we start getting declined, right? If we've maxed that credit card out, that means we've hit our limit, because we all kind of have set limits on those revolving credit cards. Our installment loans, the most common ones are going to be your student loans, your car loans, your mortgage, home equity type of loans. Those are all going to be your installment loans. They're for a set period of time typically. And for the most part, most of them come with fixed interest rates. Most of them are going to end after a certain period of time. So your car loan is typically going to be that fixed, 8 or 9% interest rate for 5 years. Once you finish making all of those monthly payments after 5 years, it's done. That's it. The loan is over. The debt is cleared. Hopefully you've paid that all on time and you're done with it. And then your service contracts. So this is going to be more like your cell phones, more your utility type of contracts, maybe a gym membership. Typically, your service contracts are not going to show up on your credit report. However, know that, for example, utility bills do have a credit reporting agency that they report to. So what happens is if you don't pay a certain utility bill after so long, that's going to go into collections, and this credit bureau that they're reporting to is going to report that to the FICO Credit Scoring Bureau, which is where most of us are seeing our credit scores, which is what most lenders are using to justify whether they're going to extend you more credit or whether they're going to deny you. So important to know that those are the 4 main types of credits so that you know how to best handle these, right? And what the difference is there. Lots of great advantages, also some disadvantages to credit these days. Again, probably the main advantage of credit these days is the convenience of it, right? It's immediate purchase power, just as you can see here. You don't need cash. It's really just a really convenient credit card that you kind of whip out and either tap or swipe or insert into a little machine these days. And it really can help build your credit score and continue to build your credit score. Of course, some of the disadvantages that you see here, we kind of tend to forget that this is really a loan, right? We're paying interest on this money, and we are paying interest on it basically as soon as we use those funds, right? So if you use those funds and the bill comes and you don't pay that bill off completely, you are paying interest on all of those funds. And because of the convenience of it, and because we've become kind of a society of the faster the better, and I want this now, that can be a really big disadvantage to us, because it can really kind of, as you can see there, really promote kind of overspending, impulse shopping, those types of things where our debt can really kind of get out of control. I like to tell people that credit is amoral. It means it's neither bad nor good, but it's the way that we use credit. It's the way that we have become used to using our credit cards. So it's really all about the educated use of it. Credit can really work in your favor. Credit can really, help you to continue to obtain more credit and to continue to pay less for things. But you've got to use it in kind of the educated way, and really kind of understanding the smart way to use it is critical, because credit really impacts so many aspects of our lives these days. Your credit report really tells creditors how you pay your debts, right? How important it is for you to pay an obligation. The lower your credit score is, the more credit will continue to cost you. Again, I'll repeat that. The lower your credit score, the more credit will continue to cost you. A really good example, and I can only speak for what we offer here at KCT, but a really good example is if you were to purchase a car today, a 2020 vehicle today, and your credit score was almost excellent, let's say 780 or above is typically considered excellent. So if you had a credit score of 780 or more, you could get an interest rate for 5 years on a 2020 vehicle of 2.49 today. If you compare that to if you had a credit score between 620 and just under 660, so 620 and 659, if you were looking to buy that same car for the same 5 years, that interest rate jumps to 11.24%. That's a difference of almost 9% interest for a 5-year loan. I see there's a few of you out there, you've got to be going, what? Are you telling me that difference in my credit score can cost me an extra 9% on a 5-year loan? That could be, I haven't done the calculation as far as payment wise, but that's got to be hundreds of dollars, if not thousands of dollars over a 5-year loan. So when you think of that, just because my credit score is not a 780 or better, you're telling me that I'm going to pay that much more. Now, there's different tiers in there, especially specifically for car loans. So there's different tiers in there. I've obviously taken the extreme, right? But the extreme means that you could be paying 9% more than somebody who has excellent credit. For possibly having a collection, possibly having some late payments, possibly during these COVID times, maybe you were unable to work. So really the point is that it affects us in so many different ways. It can affect, not just the interest rates that we get, but obviously our budget, obviously the debt that we owe. It can affect us, getting a job. It can affect us in so many different ways. So it is very important that you know how to maintain or increase that credit score. So knowing what your credit score is, knowing what's on your credit report is very important. Not necessarily that you're always going to be able to know what your credit score is. However, most of your financial institutions, I would say, are now offering you your credit report. I know that if you go onto our website, we offer you your credit report every 24 hours. And most of your larger financial institutions are offering that, as well as most of your larger credit card companies, your Discover, your Capital One, they're all offering you your credit report. How often? I'm not exactly sure on. Each financial institution, each creditor is probably a little bit different. If you don't have access to any of those, whether it's your financial institution or credit cards already, annual credit report that you see on your screen there is a wonderful website that was set up by, I believe, the FTC for you to be able to pull your credit report. And you are due one copy of your credit report by all 3 of the major credit bureaus, which are Experian, TransUnion, and Equifax. So every year they owe you a free copy of your credit report. So again, if you don't have access to, whether your financial institution is not offering it or whether you don't have any credit cards, maybe annual credit report would definitely be my advice, is go in there and choose one of these 3 major credit bureaus and pull your credit report. Now, what I do suggest is that you do this every 4 months. So if you start with Experian, 4 months from now, then pull TransUnion, 4 months from then pull Equifax. This way, all year long, you can really kind of keep tabs on where you're at with your credit report. You are not going to be able to see your credit score when you pull your own credit report in this form. However, as long as you're verifying that your credit history is all good, that everything looks good, then unless you're actually looking for some kind of loan, maybe a mortgage, maybe a car, there's no real need to know what your credit score is, because if your credit history is clean, and we'll talk a little bit more about what that means. But if your credit score, if your credit history is clean, your credit score will follow suit. What you do want to make sure of is that when you are reviewing your credit report, is that all of the information on it is as accurate as it possibly can be. So you can see here, your identifying information, some job history may be on your credit report. All of the creditors that you've ever had anything with will be on your credit report, as well as how you paid with them. Any kind of legal action. So if anybody's ever sued you, taken you to court, I don't know, maybe sued you for child support or alimony, anything of that sorts can also be on your credit report. And inquiries will be on your credit report for up to 24 months. So after 24 months, those inquiries will start kind of falling off of your credit report. It is very important that you verify that all of this information is very accurate, because any negative information in particular that is inaccurate, you should definitely correct that. You should definitely pursue all means to make sure that that is corrected on your credit report, because all of this information can stay on your credit report for up to 10 years. So for example, a bankruptcy will follow you for 10 years. It will be on your credit report for 10 years. So if it's been 15 years since your bankruptcy was discharged, that should come off of your credit report. Okay. If you had a collection 20 years ago and you see that on your credit report and that's been paid and done, and it's been 15 years since you paid that, then it needs to come off of your credit report. And if you pull your credit report through any of those major credit bureaus, so if you go on to annualcreditreport.com, you will choose one of the credit bureaus whose report you want to pull, that then sends you to that credit bureau's website. Once you are doing that online, you will have the option of disputing or correcting any information right on your computer screen. Everything should kind of be hyperlinked. So you'll have the option of doing that. What I will tell you is you need to make sure that anything that you are disputing or correcting is actually verifiably something that needs to be corrected or needs to be removed because it is not yours. So just because you're disputing something, you have a collection out there and you just don't want to see it on your credit report, if you dispute it, you have the right to dispute it, but it'll come right back onto your credit report once it is, determined that it in fact is yours. So just make sure that you are aware of, what information truly, really is supposed to be out there, because unfortunately, the burden is on you to prove that something is really not supposed to be on there. So, if the other side, if that other creditor says, well, they can dispute this, but they actually do owe us money, unfortunately, the burden is on you to prove that you don't, that either you paid that off or, whatever the case might be. It's up to you to actually prove that. So be aware of that. It can take some time and effort on your part for any corrections that are legitimate corrections that need to be done. Also know that, so for legal actions, typically these are not going to, it depends on the legal action. If somebody has sued you in small claims court, this may not be something that you see on a consumer credit report. There are different types of credit reports that are available. Most of the time when you are looking at your own credit report, this is what is called the consumer credit report. If you were to apply for a mortgage, that is a different type of credit report. That's a residential mortgage credit report that they are pulling. So it's much more detailed. It tends to be able to pull a lot more information. And, I've seen, I was a mortgage lender for about 12 years in my previous life, prior to being a financial wellness educator. And I've seen instances where, people have taken the time to really kind of make sure that their credit report looks great. And maybe they forgot that they, had a small collection out there from 15 years ago and it's still kind of hanging out there. It just didn't come up on a consumer credit report, but when that mortgage lender pulls that residential mortgage credit report, it may still be out there. So be aware that there is different types of credit report, and the residential mortgage credit report is typically one that's going to pull a lot more information compared to any others. So your credit score is determined by this little infographic here that you see here. And as you can see, the bulk of what makes up your credit score is payment history. That's 35% of your credit score, is how have you paid everything in the past. Okay. And when we're talking late pays, so if you have any late pays, when we're talking late pays, when it comes to your credit report, that means 30 days late or more. So if your payment was due on the 1st of the month and the 1st of the following month came along and that payment was not paid, now you are 30 days late. Okay, now it is affecting your credit score. Okay, so anything less than 30 days is not necessarily affecting your credit score. It's really more affecting your relationship with that creditor, with that lender. But it's not going to affect your credit score. And keep in mind that if day number 29 falls on a Saturday, that means that day 30 falls on a Sunday. That means if your payment wasn't made on Friday, on day 28, then they're likely going to report you as a 30-day late pay. Okay, so it's very small kind of little bits and pieces that where people kind of tend to go, but I wasn't 30 days late. So my credit score has now dropped potentially 35% because this lender reported me as 30 days late, but actually I didn't make my payment because it wasn't 30 days until Saturday or Sunday. You have to take into consideration that there's a difference between business days. I like to remind people, don't wait until that day 28 or 29, because if a lender does not have that payment in hand before that 30-day mark, that likely means that you are going to have issues with your credit score. So you want to keep those little tidbits in mind. These are things that not a lot of people tell us. Your lender probably certainly is not going to tell you. It's assumed that you know this information, right? So this is why I feel like things like this kind of webinar are so important, because nobody really tells us those things. But know that it's obviously very important that you pay your bills on time, and on time usually means on the date that they are owed. So, but because your payment history is such a big part of what your credit score is at all times. The other really big part of that, obviously, as you can see here, is how much do you owe? How much debt do you actually have? This is a huge part of your credit score as well, because between the payment history and how much you owe, that's more than half of your credit score right there. That's 65% of your credit score is solely based on how you're making those payments every month and how much debt do you actually carry. And this refers to how much do you owe on your credit cards, and the balances that just kind of sit out there from month to month, right? The same as how much do you owe on your car every month, right? Every month you chip away a little bit at that principal, right? If you have a 5-year car note, that first year you're kind of just chipping away little by little at that principal. But once you get into year 4, well, you owe a lot less on that car, right? So your debt has really kind of shrank down considerably, hopefully. And this is the same theory with your credit cards. If you have a running balance on your credit cards, well, this is all debt that you owe. Potentially, the more you have, the lower your credit score is going to be. So it's really important to not really carry a ton of debt out there, because this is 65% of your credit score. So the faster you can kind of chip away at some of this debt that you might owe, the better. And then the third largest factor in making up your credit score is how long have you had credit for? Your credit score is constantly looking at the last 24 months of your credit history. So if you just got a credit card a year ago, and maybe 9 months ago you got a second credit card, your credit score may not be as healthy as it possibly could be, because there's only 9 months worth of payment history that it can really take into consideration. So the longer you've had credit for, the healthier your credit score is likely to be. So somebody who's had credit for just 3 years, their credit score might be considerably lower than somebody who's had credit for 25 years or 30 years, because they have that much payment history that credit score can really kind of play off of. So, a lot of times, people kind of ask me, well, I opened up a credit card a year ago. I opened up 2 credit cards a year ago, and I've had my car for 6 months. How come my credit score is so low? It really just hasn't had an opportunity to really kind of build on what kind of history you're going to have, what kind of payer you are. So, and then that last 20% is shared between, what kind of credit do you have? Meaning, secured or installment credit versus revolving credit, right? So maybe an auto loan or mortgage, or do you have just credit cards, which are all just revolving credit? So you want to have a little bit of a mix there. And then that last 10% is inquiries. How often is somebody looking into your credit report? Right? Which really says, how often are you looking to put yourself into debt? Right? That's really what that's asking, is how often have you said yes to somebody, right? How often have you said yes to the lady at, Target offering you a discount if you apply for a credit card, or Old Navy offering you that discount to apply for the credit card? That is potentially every time you're trying to put yourself into more debt, right? You're opening up more credit. So the more you do that, the more people look into your credit report, the lower your credit score is going to be, because potentially you're putting yourself into more debt, which makes you a higher risk for that next creditor. So, the FICO score is really kind of, what is your credit worthiness? How do you make payments? How long have these creditors trusted you for? It really kind of speaks to your character. Really, and we'll look at that a little bit in a little bit more detail, but it really just kind of speaks to your character, and that credit score is really just kind of that snapshot of that moment that it's pulled of what has been happening for the last 24 months with your credit. So one of the things is, looking at, again, I touched on it a little while ago, but looking to make sure that everything on that credit report is accurate, and that if anything is not yours, you need to make sure that is corrected. Because again, if maybe you've hit some snags along the way and you just kind of have to clean house, kind of clean things up a little bit, well, you want to make sure that everything on your credit report is actually yours and it's actually being reported the way that it should be. Credit bureaus have 30 days to investigate once you have submitted some kind of discrepancy. If you disagree with the results, you can certainly, put a statement out on your credit report. However, I do warn you that if there's a dispute, let's say that you have a collection out there, and that creditor says, no, this collection is still valid, it's still owed, and you for some reason don't have a way of proving that you've paid that, unfortunately, you're either going to have to pay that, or you have the option of just kind of putting a dispute statement out there. However, know that it will continue to haunt your credit score unless it gets taken care of. So again, burden is on you as the consumer to prove that you have paid any collections. So if there's any kind of issues like that where you've paid collections, or you're trying to kind of rectify something on your credit report, I always very strongly recommend that you get everything in writing. If you settle some kind of collection, you need to get that in writing, And it needs to say that if you've paid only half of this collection, that it will be as a zero balance, for that collection. It'll be considered paid in full. And that needs to be in writing. So what if you don't already have credit, right? This is a very common question that I get again. My first go-to would be is open a secured credit card. Again, I can only speak to what we offer, but we do offer a secured credit card. Typically, they're pretty high interest rates for a secure credit card, because again, it's assumed that if you need a secure credit card, either one, you don't have credit and you need to establish it, which means nobody else is willing to take a chance on you, or two, you may have bad credit and now are looking to reestablish it, in which case that means that you didn't really pay your debts in the past. So unfortunately, again, it's going to cost you. But secure credit cards are a great way to kind of either reestablish or start establishing credit. Typically, this means that you're going to establish, again, with us, you would put a $500 deposit into a savings account. Those funds get frozen. And so you have a credit limit of $500 and it gets reported to the credit bureaus every month, as long as you're making those payments on time. Another good option, which I don't have on my screen here, but would be to do a secured loan. So a secured loan would actually be, instead of a revolving line, would be an installment loan. So same theory, you deposit a $500 deposit that gets locked. So those funds are not available to you. And then you establish an installment loan payment on those funds, whether it's for 24 months, ideally, maybe it's 5 years, whatever kind of term you might choose. But as you can see here, obviously you can try to reach out to any department stores. Usually gas stations are very good about offering credit cards. Everybody needs gas, everybody pumps gas. But usually they're very, very high interest rates as well. Almost everybody and their brother can look at your credit report these days, right? So if you're looking to rent an apartment, your insurance companies base their premiums on your credit score. So if you're paying really high premiums on your, let's say, car insurance, think about what your credit score might be. Think about what your credit history might look like. It could be potentially that it's your credit that is affecting those premiums. So it's definitely costing you more money if you have bad credit. Potential employers, right? So a lot of times when you sign that application for employment, there's fine print on there that says you are authorizing them to pull a credit report. And of course, lenders or creditors. So if you were looking for a car loan or a mortgage, certainly a credit report is going to be pulled. And what are they looking for? Well, most of your creditors and lenders are looking at your credit report because, again, it really speaks volumes to your character, how important it is for you to pay your debts and to pay those on time and to make sure that all of your obligations are taken care of. So they're looking at your character. A lot of lenders are then looking at your capital, right? What do you have in the case that maybe they give you this loan and you lose your job within the next couple of months? How are you going to pay this back? Well, your capacity speaks volumes to how you might be able to pay that back, because they're looking at how much do you have in your savings account, or maybe a retirement account of some sort, a 401k, an IRA, those types of things. Because again, it kind of goes hand in hand with your character. It's really important that I make sure that I pay my bills on time. So therefore, it's important for me to put money into a savings account as well for the just in case, right? My emergency fund. And then your capacity is the last thing that they're looking at, right? This is why they're asking you for pay stubs, for tax returns. How capable are you of paying this loan back, right? So if I'm going to give you a loan to go out and buy a car, what is your capacity to continue paying it? Meaning, what is your debt to income ratio? What does debt to income ratio mean? Well, it means that they're looking at how much monthly debt do you have, are you obligated to pay every month in comparison to how much income do you have coming in? And for the most part, you don't want to have more than 30% of debt going out the door between just your credit cards, right? Between really all of the debt that you currently owe, because you're now adding more debt. So if you're asking for a loan, whether it's a car loan, whether it's a mortgage, you don't want to have more than 30% worth of debt compared to your income, because you're also adding more debt. So you have to take into account the new payment, and your lenders are definitely taking that into account. So this is really what your lenders are looking at when they're looking at your credit report and whether they're willing to extend you any more credit. Okay. So how do you maintain good credit? Well, I kind of alluded to it in the last couple of slides, but having a spending plan or having a budget, definitely living within your incomes, not beyond your means, right? And unfortunately, I kind of alluded to this at the beginning of this session as well. We've really kind of started our bad habits. I did this presentation a couple of months ago, and I had somebody ask me, well, what's the best way to use my credit cards then? The most ideal way is you use that credit card and you pay it off every month. And by pay it off, I mean, if you use $300, then when that bill comes and it says you owe $300, you pay $300, not that minimum payment, not $100. You pay it off completely. That is the ideal way to use credit cards. This will drive your credit score faster than anything else, because again, the number one factor that affects your credit score is payment history, right? So this means that you're using your credit card every month and you are making that payment every month. The second biggest factor that affects your credit score is how much debt do you have? So this means if you're carrying a balance on your credit cards, potentially, again, your credit score is lower than what it could be than if you paid those off every month, right? So the ideal way is to use your credit card every month and pay it off every month. There's no minimum that you have to use your credit card for, right? Nothing says that I can't just buy a Coke at McDonald's once a month, charge $1 on my credit card, and pay that off as soon as the bill comes in. And that's all I ever use my credit card for, right? There's nothing that says that you can't do that. That would be the ideal way to do it, right? It's really just the fact that you're using that credit card so that you can make a payment and that you're not carrying a balance. That is the most ideal way to use your credit cards. So when I say that in my seminars, somebody actually asked me, they're like, well, then what's the point of having a credit card? I'm not going to kid you, my heart sank a little bit. So for those of you that might be thinking the same thing, my heart sinks a little bit, because that was never the intention of a credit card. A credit card is not intended for long term. This is why interest rates are so high, because a credit card's intention was for short term. I don't have the cash right now, on me, but I'm gonna, use this credit card and I have the cash in my savings account, right? And maybe I just need to transfer from my savings to my checking and I'm gonna pay this off. That was really all that credit cards were intended to do, is really to make larger purchases that you may not necessarily have the cash for in your hand, but it might be in your savings account. You might need to transfer some money over into your checking account, or maybe you just didn't want to write a check because that took some time, right? So we all kind of remember the lady that writes the check, holding up the cashier, right? We're standing behind her and we're like, really? You're still writing checks? Who writes checks anymore? But really, credit cards are meant for just kind of the convenience, but the very short-term convenience of it. This is why, again, they have such high rates. The average credit card rate in 2019, I haven't gotten the 2020 information, but in 2019, the average credit card rate was 19.24%. 19.24%. That is almost 20% that you are paying every month. So if you think about it, if you have $1,000 credit card balance that you are allowing to roll over month after month after month, and you're only making that minimum payment every month, that's a lot of money. That's hundreds and hundreds of dollars, right? 20%, that's hundreds and hundreds of dollars that you are just throwing out the window. So the intent of credit cards was never long-term. It was always short-term. It still is. It's really the habits that we've kind of gotten into, that we've kind of created for ourselves. So it's really kind of changing those habits that's going to help you, either improve your credit, and hopefully maintain that credit. So having a spending plan or making a spending plan, paying down some of that debt is certainly going to help you to maintain good credit. Having a mixture, obviously, not quite as crucial, but certainly having a mixture of the types of credit that you have, and then obviously for how long you've had credit for. One question that I get a lot is, I applied for a mortgage and, they told me that I needed to close out some of my credit cards. Be very, very careful when it comes to those types of scenarios. Because if you close out the credit card that you've had the longest, potentially you might actually make your credit score go down instead of improve. Depending on how strong your credit score is, that could be a big no-no. So, proceed with caution, I would say. The Credit Card Accountability, Responsibility, and Disclosure Act of 2009 came about with the economic crisis in 2007. It really just kind of lets you know that you need to be notified 45 days in advance for any type of changes that includes interest rate changes on any of your credit cards. So know that you do get a notification at least 45 days before any type of changes will be happening. And what you see on your screen here, this is actually your disclosure for when you apply for a credit card. Most of the time, most of us pull this out. It's a big legal size document that comes along with your cool new credit card. Most of us either toss this in the garbage or throw it in the drawer. You really should read through it. I know it's, itty bitty fine print, but you really should read through it to at least make sure of what your fees are going to be. If you're somebody that tends to, maybe travel the world, what kind of fees are you going to have, for exchange type of fees, for being in another country. You should really at least kind of browse through the disclosure. This is your legal contract that says how you have to pay. Make sure that what those late payment fees are going to be. Are you going to get hit with a fee for replacing a card? Those types of things. Those are all going to be on that contract that you receive with along with your credit card usually. So I would say before you actually even apply for anything, now this says how do you find the best loan, but you can do this with credit cards as well, right? Kind of compare those interest rates, compare all those fees. Those APRs, that APR really kind of rolls in not only the interest that you'll pay, but any kind of fees that are attached to whether that's a credit card or whether that's a loan, right? Make sure that you can calculate what is affordable to you, especially if you're thinking about purchasing a car or a home, those really large purchases. You need to make sure that those payments are affordable to you, right? Don't get caught in that 0% interest rate trap. A lot of us maybe apply for a credit card because it's 0% interest for 6 months, right? I like to call it the Home Depot trap, right? Home Depot offers it all the time. Hey, you can get 0% interest for the next 6 months. Come and do all your spring, shopping. You want your lawn to look wonderful, right? Come and do all your shopping with us, and it's 6 months, no interest. Make sure that you're calculating that payment so that you can pay it off in 6 months. Because if you don't pay that off in 6 months, guess what? All of that interest that accrued over those 6 months, you're going to now have to pay that interest. Okay, so make sure that you can afford your payment, and having a spending plan is going to really help you determine that. before you actually get into any kind of new debt. Okay. Because again, debt is the second largest portion of your credit score. So, be sure that you know whether, you're in over your head already. Because, again, it's so easily accessible. It can be easy for us to kind of get in over our head, because all we're doing is swiping that card or tapping that card, right? Now you don't even have to swipe anymore. You don't even have to insert it anymore. You just have to tap it. You just have to tap your phone. You don't even need the physical card anymore, right? So they're making it easier and easier. So we really kind of have to maintain our habits, and maintaining some sort of spending plan or budget, really kind of knowing where we're at with our debt, and what we can afford, what is affordable to us, can make a huge, huge difference. I do see a question. Can you show the how to maintain slide again? Did not finish reading it. You know what? Let me go through all of this and I will show it at the end. Because I think we're a couple ahead of it already. But yes, I will keep that in mind. How can you avoid excess debt? Again, I kind of talked about it in the previous slide, really kind of having a spending plan in place already. We offer a building a basic budget seminar. So, you're free to join any of our seminars at any time. I know Gale Borden Library has hosted a couple of the budgeting seminars as well, or debt management. So, debt management is huge. It's a huge part of it. And I know a lot of us kind of struggle with that. It's really just a mindset, right? Determining, what your needs versus your wants are, and really kind of taking the time and putting in the effort to take the time to determine a spending plan and to really kind of, change your habits. So it definitely is a mindset of, what do I need to do? Maybe I need to pay off some of this debt first. And this is how I'm going to start improving my credit score. Or, maybe you're just starting off with credit, and you need to really be determined on, I am not going to go over, I'm not going to spend any more than what I have in my account. This is strictly just to start creating my credit score and improve my credit. And at some point I'm going to purchase a home, so I want to make sure that I dot all my I's and cross all my T's there. So and certainly having an emergency fund. Not necessarily living paycheck to paycheck is certainly going to allow you to start putting money into a savings account and really avoid any of those, financial mistakes in the first place. So even if you're drowning in debt, right? Some things to stay clear of, payday loans. I've seen payday loans charging 300% interest, which is, if we thought 20% is crazy, 300% is certainly mind-blowing. So just really, watch out for any of those advertisement. We can repair credit. I kind of started off the session with, saying, you really need to make sure and make sure that everything that's on your credit report is yours, and you can dispute any information on your own. It really comes down to, how busy are you, and maybe the convenience of it. If you have the money to pay somebody to really kind of help you fix your credit report, then by all means. However, you are able to dispute anything on your own. You are able to make any corrections on your credit report on your own. Again, it can take some time. It can be very time consuming. But if you're determined to do it, it certainly can be done. Doing something like a debt checkup is a great option. So reach out to your financial institution and see if they help out with any kind of, debt checkup. That's what we call ours. I don't know, they may have a different name for it, but really kind of just going through all of your debt, seeing where you're at with everything, kind of helping you get everything organized is a excellent start. So if you are a member with us, certainly reach out and, we would be more than willing to do some sort of debt checkup. But if you are not a member, I would say reach out to your financial institution to see if that is actually an option. And with that, we got about 7 minutes, and I do want to go back to how to maintain credit slide. Let's see if we can get back to that. Otherwise, with that, Sadia, I don't see any other questions unless you do, or comments. I'm going to go back to the slide.
Yeah, I'm not seeing any other questions or comments. We have a few more minutes. If anyone has anything, please feel free to, you can actually raise your hand if you want to verbally ask, then we can do that too.
Yes, this is actually one of the pretty long slides here. So again, creating a spending plan and having some sort of budget, making sure that all of the information on your credit report is complete and accurate and is actually yours. Obviously, making sure that you pay all of your bills on time, having credit but not too much credit. So that really kind of refers to a lot of times I get asked, well, how many credit cards should I have? And in my personal opinion, because I've been a mortgage lender in the past, I was also a homeownership consultant in the past for about 5 years. In my personal opinion, if you have more than one handful of credit cards, you may have too many credit cards. That's in my humble opinion. There's plenty of people out there that have multiple credit cards who have excellent credit. So, and then a mixture of credit, again, not just all revolving credit, but having some sort of installment loan at some point, making sure that those credit card balances are low, if not at zero all the time, knowing what your debt to income ratio is at, consistently. And making sure that that debt to income ratio is a lower than 30% debt to income ratio. And obviously then just demonstrating stability. Again, this refers to, how long have you had credit for? The longer you've had credit for, obviously the better. Not a whole lot you can do about that if you're just establishing credit. Obviously, it's time. But other than that, that is all that I have. So, Sadia, I don't see anything else. So I think we are good.